Let's delve into that macro discussion. Maithili Busamat, like I said, our consulting editor, joins in with her perspective on things that are shaping up across the region. And it's been quite a tumultuous start, really, to trading year 2016. Killol Pandya, head fixed income at Pearless Mutual Fund Management, also joins in with his view. As in a bit, we will have Raman Ananth Nageswaran, who's independent financial markets consultant, who understands the China market. Sitting out of Singapore, will also be joining us for moments in a bit from now. Good afternoon to all of you. Maithili, let me start off with you. How are you looking at the China story? It's well documented. I think it's just the sense that, the extent with which they've announced the devaluation news and the back and forth that the authorities do, the communication gap that there is from their end to the markets, that is making investors across the globe a bit nervous.
Well, I fear this is not the last that we're going to see from China. I think this is going to be, the third or fourth such instance that we're going to see when the Chinese authorities do intervene. Because after the first massive intervention we saw last year, we did see another smaller play out again towards closing days of the previous year. And now again, we've seen again a massive fall, in fact, two falls in the same week. So I think as the Chinese economy slows, and the unfortunate part is that one really doesn't know the full extent of the kind of slowdown in China. There are conflicting stories coming out that actually the slowdown is much worse than what the world knows so far, in which case the Chinese authorities will intervene. Because however much they talk about having shifted to a capitalist model of growth, as far as the economy is concerned, the fact is that when the Chinese slowdown is, faster or slower than what the authorities like, it does become a command and control economy, and the authorities do intervene much more aggressively than they do in the case of India. So I'm afraid this is not going to be the last of the tremors we're going to see from China. And each time, given the size of the Chinese economy, we are going to see the world economy as a whole convulse in these, terrible ways, as it were, if I can put it. So that is the unfortunate reason that we're going to see that as and when, until the Chinese economy reaches a level, a new normal, we don't know what the new normal is, and that really is the biggest problem before the world. It also poses an additional problem for the US Fed, because it does not know, does it really seriously take into consideration the slowdown in China? That's what they had said in September. And October, again, when they held rates constant. By December, they felt that they could hike rates. One doesn't know whether the latest turmoil will again make them pause. And what does that mean, really, as far as the global economy is concerned? But I don't know whether Killol shares that view. Killol, do you think that we've not seen the end of the present drama? And this really, the roots of this lie in the previous regime. In fact, not just the previous regime, in fact, going further to Alan Greenspan and the kind of excessively easy monetary policy that he had really imposed on the US Fed and hence in the world at large. Killol, do you share that view, that we are paying for our past sins?
The posers which you have been placing are actually the questions that are exercising all of us currently, and these are very important issues which all of us are grappling with, and obviously there are no easy answers. Coming back to the last point which you raised regarding us as metaphorically paying for our sins or past excesses, that actually, I would like to draw attention to the debate which is currently going on regarding whether quantitative easing has actually served its purpose. In fact, our governor also has, expressed doubts at various forums regarding whether the entire gambit of flooding markets with cash for an extended period and providing succor by a kind of having almost unlimited lines of credit by the government, kind of printing cash and buying securities, has that gambit paid off in bringing about economic revival? I think the jury is still out. It's too early to tell. I completely agree with the question, the discussion which was going on regarding the China effect on the globe, especially the US-China dynamic. That is something to watch out for. Yes, the entire equation becomes very complicated because there is a lot of debate about the veracity of data emanating from China. Fortunately, as fund management professionals, our sphere of interest is a little more modest. We have to take a look at how these events are going to impact us in India. I retain my belief that eventually India will be the beneficiary of a China slowdown. As long as US is recovering gradually, India will benefit as an economy. Even if our economy does slow down, which it probably may, we will continue to be the best emerging market, and we will continue to attract monies by way of FDI as well as continuing FII interest. So yes, the Chinese conversions, as it was mentioned here on the show just recently, will affect India.
Each state is today counting how do we make business easier in the state. You make business easier by having a stable policy, and therefore convince summits of this kind held year after year demonstrate a clear intention of a break from the past, where there is an increasing realization that economy will work only if large businesses, large economic activity comes into the state, which creates jobs, which gives us revenues, where an enriched state government then can enable and service its poverty alleviation programs. There are still many challenges that we have. If we look at ourselves nationally, our services sector has significantly improved. It's been more or less consistent. There are now green shoots visible in the manufacturing sector, which after some period of slowdown is now picking up. But we've had two continuous less than normal monsoons, which pulled down the agricultural growth rate, which in fact impacted purchasing power in the rural areas. Fortunately, West Bengal is blessed with a lot more water than is available to the rest of the country itself. Now, it is in this situation that we are looking forward to a situation where the glory of a state like West Bengal can always be restored back. West Bengal.
Anand, I don't know how much of that discussion you heard that I was having with Killol before, we heard the FM speak at the West Bengal Summit. But I was asking Killol, and this is a question I'd like to throw your way also, is this the last of the tremors that we're going to see from China, number one? And related to that is a question, that is this tremor, did it really originate in China, or does its source go further back to the US? Anand?
Yeah, I hear you very well. The very straightforward answer to your first question is this the last of the tremors that we are hearing or getting from China? The answer is an unequivocal no from my side. I think the rot has been setting in for quite some time. I don't know whether you want to throw it back to the US. I would throw it back all the way to the Chinese response to the 2008 global economic crisis, when they unleashed a massive financed economic stimulus. And the banking sector lent as if there was no tomorrow. The non-financial corporate sector debt has ballooned. So the origins of the current predicament that Chinese policymakers face and the crisis that the economy faces should be traced all the way back to their knee-jerk and panicky reaction to 2008 crisis.
Anand, that sounds very suspiciously like what we did in 2008, because we did also see in India, we saw a credit fuel boom. We also saw the government apply its own fiscal boom as stimulus as well. So are we going to head the Chinese way, or are we a little bit more cautious? I mean, I hope we can have that distinction, because we've always prided ourselves in that we've managed our house a little bit better.
You're posing a very, very important question that is glossed over in India. I think, yes, India also responded in similar fashion. So there is definitely a convergence in terms of the spirit of what both India and China did. But I think the magnitudes vary quite considerably. And therein lies the problem for China more than it does for India. But that said, I think India's current growth struggle does originate from that crisis response, the extraordinarily long and pro-cyclical fiscal stimulus and the corporate sector leverage, etc. All these things are not being recognized adequately, and a lot of us are focusing on the fact that India would be relatively a faster growing economy in the world, which I think is a statistical fact, but I think it is growing far below the potential it can, and we have not yet addressed the systemic issues thrown up by the post-crisis response, and also some of the structural fragmented nature of Indian agriculture and manufacturing that will continue to hobble India's growth. So I think there is far too much complacency in this country about India's relative resilience at this point in time.
Killol, would you share that view of Anand, that there's far too much complacency, and actually the roots of our problem also go back to the response that we saw to the 2008 crisis, and particularly we are seeing now the way corporates are so heavily over-leveraged and they're not going to be willing to invest. So ultimately it has to be public sector investment. And what does that mean for the fiscal deficit, particularly for somebody like you who's in the fixed income market? What kind of response are we going to see, in fact, closer today to the auction of the government securities today by the RBI? There's 8,000 crores on offer. Will FPI still have that kind of appetite? What kind of deals can we expect, Killol?
To answer in order, yes, we also have had our share of fiscal stimulus. Some of the issues plaguing us do trace back to the quantitative easing paraphrased, which we had as a response to 2008, and which is why, as I mentioned earlier, even the governor has questioned the effectiveness of quantitative easing as a medicine for the issues faced by the economies, especially in terms of flagging growth. Yes, some of the issues, including ballooned debt, partly some of the NPAs also can be traced back to 2008. However, what interests us as market participants is not the dissection or the analysis of how things have come to be, rather than what interests us is focusing on what's going to come to pass in the future. Going ahead, as I mentioned earlier, I continue to be a votary of India. I am India positive. The complacency or the fragmented nature of the agricultural sector, the kind of reactionary nature which is spoken of, has been part of the Indian economy for some time, and I think it is not something new that we have been performing below what is our potential. But to kind of give a peculiar angle to this question itself, I believe the statistical calculation of what is our potential growth also from a qualitative perspective must add in these factors, wherein the fragmented nature of certain key sectors of the Indian industry, as well as the fact that as an economy we are extremely diverse. As a polity we are extremely diverse, and so it's never really been possible for us to turn on a dime. I mean, these factors must also be put into the equation, wherein we look to calculate or look to estimate what our potential growth is going to be. From that perspective, at 7.4 and eventually 7.7, which is the kind of estimate we are drawing for the coming years, I believe India is doing extremely well for itself. And once we put ourselves in the context of how the globe is going to perform for the next couple of years, I think Indian attractiveness is intact. Further boring it down to how FPIs may participate in India, I think their interest is not going to flag really. We are seeing continuous interest in the Indian sovereign space, which is of course the most liquid. And again, boring it further down to the question which you raised last regarding how our 10-year is going to how the auctions are going to fare. The old 10-year was trading at about 770. In the when issued market, the new 10-year is trading at 55.58. The interest is self-evident. So to encapsulate it, I retain my positivity about India. Fine, we may not be functioning at our optimal level, potential level, etc. But I don't think that is taking anything away from the attractiveness which India has as a market in the coming quarters and coming years.
Anand, Killol reiterated what we've heard before, that the Indian economy is doing relatively well as compared to other global economies. And we just saw the World Bank also reiterate that, even as they lowered the Chinese growth for this year, for the next year and this year as well, to 6.7%. Now, is that 6.7% for China? Does it reflect the true state of affairs? Or can we expect to see, I think we get the third quarter numbers later this month for China. So what kind of number can we expect to see? Because the Communist Party has already lowered its growth estimate to 6.5. And how will the world economy react to a lower estimate? What kind of GDP estimate are you expecting to see from China?
Oh, I think the numbers 6.5, 6.7, etc. are quite meaningless because now everybody accepts that depending on their favorite measure of GDP growth proxy, China's growth rates are anywhere between 2.5% to 5% at most. 5% is actually quite optimistic, and I think I think these numbers lack credibility completely, and therefore we shouldn't be worrying about whether it is 6.5 or 6.7. It is far lower than that. I think China will continue to exert a deflationary force on the global economy. It will definitely lead to intensified currency warfare between emerging economies and also with developed economies. So I think China and the United States, in my opinion, because of its own stock market bubble and junk bond growth in the U.S., both these economies and markets are going to be major risks for the global economy. And much as we can say about the relative attractiveness of India, when there is a global sell-off, there are no relative safe havens, and I don't think India will fare any better. Maybe there is a percentage point or two relative performance in stock markets, but India is not cheap either. So I think China's growth is far lower, and as for India's relative status is concerned, that will be very little consolation for investors in the final analysis.
Okay, so that's a word coming in from Anand, and with that, would like to thank Maithili, Killol, as well as Mr. Anand for taking the time out and sharing their perspective, as well as highlighting those macro cues. Let's quickly slip into a short break at this point of time, but we have lots lined up on the other side. We have a lot of stocks to highlight, so please do come back.